Hey everyone, this is a detailed analysis of the case study that we did at our studio opening party, and we did a live episode there, and a handful of the financial advisors and brokers shared for a couple of minutes what they would do in the situation, and I asked them they would be welcome to send a full video through of a detailed scenario, and this is one of them. This is Scott Taylor from Everest Wealth, and you're in great hands. Have a listen. It goes for about 40 minutes, and there's details in the description below if you want to get in touch with the team at Everest Wealth. They've got advisors all around Australia, and they certainly do remote advice to wherever you are. Thanks so much for watching. Over to Scott.
Hi there. My name's Scott Taylor, and I'm from Everest Wealth. Glenn has asked me to do an extended version from the live podcast around the case study that he provided. But just before I get into that, I just wanted to explain who we are. So we're a financial planning practice, a national financial planning practice, offices in Melbourne and Perth, a team of 30 of us with 9 advisors. And our sole focus is to help people under 50 get ahead sooner in life. And essentially our motto is to help as many young Australians as possible feel the financial confidence they need to create the wealth that they never had imagined. So that's kind of our philosophy and what we're about. But with this case study, if I get into it, where we would start with Sam and Olivia is really as in an initial meeting, which is at our cost, no cost or obligation to Sam or Olivia. We would explore more about their current situation and really delve deeper into the why and what they want to achieve. So we would ask a number of open-ended questions and kind of closed-end questions as well, just to gain a better understanding of their situation. So if I look through the case study that I've got on the screen here, some of the things that jump out to me, firstly, is around, if I'm just working down logically around Olivia's work, there's a mention there that she's happy to add one day. Well, maybe not happy, but she can add one more day. So I guess exploring and unpacking that a bit more around, does she want to do that? What would that look like? Sam's parents would be able to look after the kids by the sounds of it, so not an extra day of daycare and cost there. But what we find when parents retire, they'd like to travel more. So is there going to be weeks, months of the year potentially where they won't be able to help? So there's that more annual leave, and how much leave does Olivia have? And so just exploring that more. Moving down to the house, they don't mind the location but may outgrow. So it's really exploring this. This is super important in our opinion, given how quick house prices have been moving and potentially will likely to continue to move upwards with the pressures on the housing market in Australia. We really want to explore whether they do feel that they may need to upgrade at some point in the next 10 to 15 years with 2 young kids. A 3-bedroom, kind of 1.5 bath, is that really what they want to share with 2 kind of teenage children? If the answer is very unlikely, then we really need to delve into that around, is it, can we renovate, and what would that look like? What are some of the costs that would be involved there? Or do we look to upsize, which would cost more if we're looking to stay in a similar location? So do we look to try and bring that forward, which is part of the case study that I'm going to explore today? Going into the mortgage rate, so asking if they've got a mortgage broker, 5.97% isn't as competitive as what it probably could be at the moment. This has been recorded on the 10th of December 2025. Interest rates out there around 5.3%. Bit of talk at the moment about potential increases in 2026 now. So potentially they may get back up to that kind of close to 6% level, but an introduction to a mortgage broker or speaking to their mortgage broker to potentially review that interest rate, which would save them some cash flow. Each person's pay into one account. We would then start exploring how comfortable they are with money, where they see some of their pitfalls because they feel financially stressed. So what does that look like? How do they feel as a result of that? And then are they happy to consider merging and kind of be on the same team, I guess, with the money, and it's all kind of in one pot rather than being kind of individual to an extent. The account for the kids, exploring what's that for. Is it for when they're kind of adults to go towards a car, home, uni, or is it for more Christmas presents and day-to-day stuff in the short term? If it's for future, what we would look to explore is, well, should we be potentially investing that money through a minor account, through an account in Olivia's name, through a trust, through a bond? A lot of options out there in terms of structures of investments, but typically, given the ages of their kids being 5 and 2, we've got a lot of time on our side. So historically, it would make more sense to potentially invest for their future rather than just putting it into a savings account. Moving down to their super, Sam's high growth, Olivia conservative. We would really explore more here around their risk profile and ask a lot of questions around their tolerance to taking on risk. What that means is by taking on more risk, you're more exposed to growth assets, that being shares, property, commodities. What that means, though, in the short term is that there'll be more volatility likely, so more ups and downs with the portfolio. But over the long term, typically historically you'll be rewarded as a result. Again, given Sam and Olivia's ages, current rules, we can't access superannuation until we're at least 60 years of age, unless another condition of release is met, like passing or permanent disablement. So we've got over 2 decades to invest this money. That's a really long time. So really explaining that to Sam and Olivia and potentially bringing Olivia up to more of a high growth strategy there. And I'll get into some of the benefits of that through this session. In terms of the investments, so how much are they currently adding into raise? Why raise? Are they doing the roundup? Is it just easy, the micro investment to get started? Now that their balance is starting to get a bit higher, potentially there's some other options given the cost, and I'll explore that a bit more. So some questioning around the purpose of this investment, how much goes into it, how have they felt more recently with some of the share market drops? Are they regularly checking? Does it make them nervous? That will all give us a really good understanding of their personalities and how they feel about investing. Moving into the debts, sounds like they use a credit card, can't clear it every month, paying a little bit off each week. So it sounds like that their cash flow is not in a great positive position, which is very common for families with young kids and a relatively large mortgage. So a large component of what we do is really helping people with their cash flow and budget is kind of not the nicest word, but it's kind of setting some parameters around their spending habits so that they feel more in control and there's a plan to reach their longer term goals. The car loan, I'm going to assume for the purpose of today that the interest rate is higher than their mortgage. So it is higher than 5.97%. Excuse me, but essentially delving deeper into some kind of questioning around what the repayments are, what the interest rate is. Moving into the goals with the Olivia's Nan gifting some money, we are assuming that Olivia's Nan is not passing away. It's an early inheritance, early gift. We would want to confirm what that gift is comprised of. We'll assume it's cash, but a lot of the time it could be shares, could be a share in a property. That would be important to understand because there could potentially be some tax implications upon selling. What does it look like to pay off the home faster? Is there a goal by 50, 55, just quicker in general? Where have they heard about refining to pay off the car loan and why do they want to do that? In terms of keep adding to the raise account, like what's the sort of thinking at the moment in terms of investing versus the next comment around growing Olivia's super versus home loans? Like kind of want to do a bit of everything. Is there a priority order here that we can kind of work out together? So a big part of what we do early on in the conversations is understanding people's goals, even if they feel like they're really unachievable and unattainable. Let's put them down and see what we need to do to make them happen, or what sort of time frame that they could happen in. Olivia is concerned about her super growing too slow. So we'll unpackage that a bit more. Same with the self-managed super fund point there. School costs, we'd delve deeper into what sort of school that they're looking at, schools they're looking at, what sort of fees, because private school can range drastically from kind of $5,000 to $10,000 all the way up to $40,000 to $50,000 a year. So that would change drastically the proposal and the advice that we would do, and whether it's even possible, particularly if we're looking at upgrading the home, keep investing, adding to super, pay off debt early. There's a lot of competing factors here. But first and foremost, like the last point is get organised with their finances. So in terms of our process here at Everest Wealth, after the initial meeting, our alignment meeting, which there's no cost to Sam and Olivia for that, we would have had a really good understanding now of their situation, their priorities, how we would help them. So we would really delve deeper into that and what we would charge for our work. And we charge a fixed flat dollar fee, a one-off fee. We then would collect a lot more information once they're happy to proceed. Stuff like pay slips, bank statements, raise investment statements, a few questionnaires completed. Then we'll need about 2 weeks to complete the initial strategy ideas. And then we can report back and have our first strategy meeting with the clients. Now, for the purpose of today, this is general advice. It would be remiss of me not to say that. It's not intended to be personal financial advice, and it does not consider your individual goals, financial position, or needs. So please don't rely on this information as a substitute for personal financial advice. But going back into Olivia and Sam, we then start running some reports for them. Okay. And this is the sort of strategies that we would then look to potentially bring up with them and deploy moving forward. So where we normally start is getting some really strong foundations, emergency fund, cash flow structure in place, because if we get those strong foundations, that gives us the platform to really launch off and work towards their goals here. So we try to kind of bring their goals into one kind of succinct part here, which is pay off home loan, get rid of the car loan, continue investing. What do I do with the inheritance, schooling, get organised, and then consider a potential property upgrade. From there, what we do is review people's spending. Now, this can be a bit daunting and confronting to some people. It is not designed for that. What it is to get the data accurate. So we delve deep into the transactions and categorize it at a high level for both Olivia and Sam. And that will show, okay, we're spending X amount on bills, mortgage, insurances, childcare, groceries, like the boring stuff, but the stuff that is essential. And we're spending X amount on the fun stuff, holidays, going out for a meal, taking the kids to the zoo, takeaway, retail shopping, Christmas presents, the stuff that, is lovely to do, but it's not an absolute necessity. What that then tells us is then we can start going, well, if we keep your lifestyle the same, what's our position? Because it seems like at the moment, they really don't know what their position is. And then we start building it into some annualized tables. So what we're showing here is Sam and Olivia's current salary, less tax. They have $163,000 coming into their household each year. Based on the review of the spending, now I've made some assumptions here. They're spending $156,000, including the car loan, credit card, and mortgage repayments. That leaves them with a surplus of $6,800 per year, or $262 per fortnight. So if we're thinking about upgrading the home, potential school fees, being debt-free earlier, it's probably not enough surplus to achieve some of these key goals, or definitely not enough to achieve all of them. So then what we look at is setting some parameters together, and we really get the buy-in from Sam and Olivia at this point in time. And what we find is through this process, as you'll hopefully see as I continue on, by seeing what the final outcomes are, people are way more motivated to then stick to some new parameters because they see where it's going to take them as a result. So these are some really minor suggestions, but typically we make these initial suggestions, we show where people can be, and they want to tighten that more and kind of really got a lot of motivation now to really aim for the stars. So we've cut back holidays a bit, cut back their discretionary area, which then just increases their surplus to $15,000 a year. So we've saved or cut their spending by close to $10,000 a year to get us now a surplus of $577 per fortnight. What we then look at is clearing the bad debt. Glenn talks about this a lot. Get the house in order, get a spending structure in place, get rid of consumer debt, bad debt, and then focus on your goals. So we would cease investing. We would cease kind of any savings plan until this bad debt is gone. Now, some quick wins here would just be to use the existing savings they have of about kind of $18,000 to $20,000 to clear the credit card, cut up the credit card, or put it in the bottom drawer, and let's stop using it. Remove any direct debits from it and put it onto a transaction account. That would be what we would immediately do. Interest rate 18%, not paying it off before the interest-free period. It's costing them quite a bit of money. The car loan, we're assuming a 10% interest rate, $22,000 owing. If we're going to refinance the home loan through a mortgage broker anyway, given the interest rate's a bit higher at the moment, why not add in the car loan? Now, worst case, if we were to refinance it at a similar interest rate, fortnightly repayments on kind of using kind of 25 grand as equity so that they can keep a $20,000 buffer as an emergency fund would be $72 per fortnight. So it would lower their repayments. The downside is it means they have debt for longer, whereas a car loan typically is a 3 to 5 year term, a mortgage 25 to 30 year term, but they're paying less interest and they can always put those extra repayments back into the mortgage to pay it off quicker as well. We do need to look at if they've got any equity though. So how equity works is typically you can pull your loan up to 80% of the value of the property, assuming the bank will allow you to service that through your incomes. So if their property is worth $950,000, current home loan $610,000, they can pull their loan up to $760,000, which is 80% of the $950,000. That gives them $150,000 of usable equity or cash for clearing the car loan, renovations, investing, potentially considering another property or an investment property. So the recommendations here, clear credit card with cash, potentially look at using equity through a mortgage broker to clear the car loan. What that then enables is a higher surplus. Now the car loan's gone, the mortgage is slightly increased through the equity loan or the withdrawal there, and no more credit cards, so no repayments there. Our surplus has now gone up to $20,438 or $786. So each moment we are increasing this surplus, which is really important given their goals are going to require some pretty significant cash to go towards them. Now, sticking to a new regime, a new budget, some parameters, how do we go about that? We then look at working on a structure with these clients. Now, everyone is going to be different. Every client we speak to is slightly different in terms of their mindset about money and what works for them. Some people that I've spoken to love having 10 different bank accounts, an account for each little thing. Some other people hate that and it's too overwhelming, too complex, and they just like one or two bank accounts. The two things we always suggest with our clients is that we have a hub that we're paid into. So we've assumed that Sam and Olivia are happy to merge and we're going to combine everything together. We have a hub that we're paid into, but we don't spend money from. That just then captures all of our surplus, all the pay increases. When Olivia potentially goes to 4 days a week, that amount just automatically gets captured rather than going into an account that we spend money from. And it feels like we're richer. And typically then what we see is lifestyle creep and people spend more. Every fortnight, money gets spread out automatically to the spending account. So we then have an account for all the boring stuff, the bills, the groceries, the fuel. And then we have a separate transaction account for the fun stuff, going out for a meal, takeaway shopping. The mortgage gets paid every fortnight. And then lastly, we have a savings bucket for the holiday account. Ideally, this is another offset account. So working with the mortgage broker, if we are refinancing, potentially considering a bank that has multiple offset functionality, so that all of these accounts can be offset accounts. But if that's not possible due to whatever reason from the mortgage broker, then we feel having a savings account for the holiday will still bring better habits, because what that then enables is Sam and Olivia can almost on a fortnightly basis exhaust their fund money, knowing that they don't need a future plan for travel arrangements. Oh, we've got to pay for those flights next week. We better go easy on our spending this week. There's already a bucket being kind of put aside, $10,000 a year for that. Now, like I said, some people want more accounts. Maybe Sam wants his own spending money for when he goes and plays golf, and Olivia wants it for when she catches up for a drink with the girls. We can kind of work on this, but this is a starting point. What this enables is real clear structure without the need to necessarily track it through spreadsheets or really have those kind of financial stress. It's really clear. Got 2 bank cards. When one's the bills are all covered for, because we've done that review on their bills, and we would encourage them to increase that kind of by 3 to 5% each year to account for inflation. And then the discretionary account is more the way that we want to track it away from credit cards. So once that's in place, then we can really launch off and go, well, what are we going to do with our money? First and foremost, we always want to keep a good buffer in cash. For Sam and Olivia, we feel 20 grand is a suitable amount, because Phil and Sky Wealth are going to look at some insurance and get some income protection in place, which would have a 2 to 3 month waiting period. So this will get them by with a bit of sick leave for the time being. Then we need to look at their goals. So after the initial meeting, it was really clear to us that the house was going to need to be upgraded, and they didn't want to look at renovating because they had nowhere to kind of take their family, and the costs were just going to be too great to pay for a rental for a year, plus waiting for paying for the mortgage on the house and the extra mortgage on the renovation. So we need to look at moving. So what we want to look at first is, ideally, can we keep the current property as an investment property and then move out and use the equity and Nan's inheritance to purchase our next house? So we would set up a savings plan in the offset account for their surplus. So that number before of $785 per fortnight, building in their offset account, will get us in a year's time when Nan's inheritance of $200,000 comes in, of $222,000. We're assuming that the house upgrade from their $950 current value of their home would be 1.3 mil to get a kind of a 4-bedroom, 2-bathroom property. Stamp duty about $53,000. They'd have a $222,000 deposit. Unfortunately, a large amount of LMI. Final loan value, if they could even borrow this money, would be $1.2 million. Repayments based on 5.6% interest rate, principal and interest, just shy of $7,000 per month. So if we look at that and then try and plug that in, assuming that their existing property would get a conservative 4% yield. So what that means is a 4% income from the value of that $950,000. So $38,000 a year in rent. They'd be able to claim the interest and some deductions and some depreciation. So we've gone really conservative with those deductions. That would then give them extra income, a positive tax return, given that it would be a negatively geared investment property. However, as you can see there, $83,000 in new mortgage repayments, on top of adding in $5,000 for extra home ownership costs of more council rates and some extra bills there, puts them in a position where they're down $23,000 a year just on a week-to-week basis, not including their tax return. Even with their tax return, still in a really hefty position. This is also with Olivia going to 4 days a week. You may have noticed her income has increased there. So with all of that, it really isn't achievable unless they significantly reduce their spending. But even if they do that, there's no money to invest for schooling or put aside for schooling. So it really does rely on higher incomes to make this achievable, which is probably a bit unrealistic to expect based on our conversations with Sam and Olivia. So what's the more realistic option? It's the sale and upsize. So if we sell and pay off the debt, if we assume an agent's going to sting 3%, which typically it would be closer to 2%, but again, trying to be conservative with these numbers, they walk away with $283,000 on top of the inheritance in 12 months' time, on top of the savings that they can do over the next 12 months, gives them $500,000. That then means that their debt is a lot less and therefore their repayments are under $5,000 now. So $2,000 per month less in terms of repayments. So then we go, okay, well now how does that look in terms of their position with Olivia on, again, 4 days a week? With the new mortgage repayments, we're now in a positive position. So it has really turned it around for them as a result, because now they've just got one mortgage, not two mortgages. Yes, they don't have rental income, but they're now in a positive position of $18,000 per year or $700 per fortnight. So this doesn't even need Olivia to go to a 0.8 FTE or 4 days a week. She could stay at 3 days a week. Ideally, though, for other goals to be met, that would need to occur. But it puts them still in a really healthy position without really having to change their lifestyle too much, if you recall from the very beginning. So that's kind of goal one done. Now we want to look at, well, what's next? We've got other goals of being debt-free earlier, investing, school fees. So if we do nothing with the debt, we're going to be debt-free when Sam's 67. That's not ideal because we want to aim to be debt-free on our principal place of residence by the age of retirement, ideally 60, to give people options of partially retiring at that age, if not fully retiring, depending on their super balance. If we were to put that $705 against their mortgage in an offset account and just keep building it, it would save them 13 years off their mortgage. They'd be 54 years of age, Sam's age, and would have saved about 450 grand in interest over that journey. So that's one option. That's just focusing solely on the mortgage. Again, no school fees have been considered, but that could come out of that offset account throughout the years that their two kids go through the 6 years of high schooling. The other option that we have is investing. Now, they both completed a questionnaire and it showed that Sam was more of a balanced investor. Olivia was more of a moderate growth investor. What that means in terms of a risk profile, Sam's comfortable with a 50-50 mix between growth assets, shares and property, defensive assets, more cash and fixed interest, and Olivia's more comfortable with 3/4 growth, 1/4 defensive. After the discussion, and showing them some kind of long-term return charts and the probability of making money longer term and how much kind of that difference between the share market versus safer assets, they were happy to move to a high growth. So that's the sort of conversation that we would have, a lot more in depth than that 10-second spill there. But that is an important part. Now, sometimes people aren't comfortable going to high growth. That's completely fine. We educate, and then people make an informed decision for themselves. But we always guide you where we believe it makes sense for you to sit and be based on getting to know you and then also the numbers and the financial position. So if we then look at investing their spare money, so the $705 a fortnight on top of the $4,800 that Olivia already has in raise, in 7 years' time, there'd be $164,000 in for school fees. If they didn't use it for school fees, they would have $621,000 at age 54 to clear any remaining debt. Or if they just left it by age 60, they would have $681,000 and then that, 55, and then that could be used to partially retire and draw down from. Now, in terms of that drawdown, if we're looking at the last thing, which is using it to partially retire early, what that enables is $43,000 in today's value from when Sam's 55 to 65 to prolong the need to use super which is essentially Olivia's after-tax income at the moment. So they could both kind of drop a day or two, or Olivia could fully retire at that age and Sam keeps working, as an example. We always try to be quite conservative with our return assumptions. So 6.89% is the assumed return for this portfolio. Historically, the share markets have done close to 10% over a long time horizon. But again, just trying to be more conservative with these numbers. But I guess with the point of this, if we do this, we're not attacking our debt any earlier. So then debt's held till 67. It would just be likely a combination, because what I'm showing here is focusing on debt 100%, focusing on investment 100%. And then the conversations start to be, well, where should we sit in the middle as we start to uncover what their priorities are as we delve into what really does resonate with Sam and Olivia here. In terms of then the investment itself, so if we were to add any more to their investment portfolio, we would consider that potentially raise is not the most suitable option for them moving forward. And the reason for that is the fees. So we would look at, well, what are the costs? Raise has kind of some set administration dollar fees, which for a lower balance can add up. So what we would look at is a platform ideally that has automation, easy to use, doesn't tie you into an advisor, and has the options that we want, which would be a low cost ETF, likely a passive ETF, set and forget, more kind of buying into time in the market rather than trying to time when to get in and out of the market. And as an example, this is a Beta Shares kind of diversified option, 0.19%. So as an example, it's much cheaper than Raise. So more money is getting invested and therefore got more chance to grow quicker over time. We would then look at the structure of the investment. So should it be in Olivia's name? Should it be in Sam's name? If we're comparing those two, and Olivia is likely to be on a lower tax income than Sam for the foreseeable future, it would make sense to likely be in Olivia's name for tax purposes. We'd consider investment bonds, education bonds for future schooling. We'd also consider trusts. So we'd consider all this. Everyone's going to be very different. There's pros and cons with each in terms of higher fees, lower fees, higher taxes, lower taxes, accessibility. It really just depends on the situation. But this is as well what we explore with our clients, and we would explore with Sam and Olivia. So going back to the case study and their kind of goals and comments, we've then kind of focused on what to do with Olivia's nan's money, which is to put it into property, because after delving deeper, that was actually really important to them. We've then discussed paying off the home faster versus investing. And after the whole conversation, it would likely that we would meet somewhere in the middle. We've paid off the car loan. We've got into better habits with our spending, got rid of the credit cards. We've got a strategy now around school costs, which is the investment plan. We've also got a strategy to be debt-free by 60 because we met in the middle. And now it's about the superannuation. So when we look at superannuation, we want to look at where they're currently invested. So for Olivia, she's in Aware Super in their conservative option, has $48,000. Let's unpackage what that conservative option actually is invested in. 43% is in growth assets, 56% in defensive assets. Growth assets being top couple hundred companies in Australia, international shares, US, Asia, and Europe, fixed property, and then defensive assets. So cash is money in the bank, savings accounts, fixed interest, bonds, term deposits. For Olivia, as we've discussed through discussing her risk profile, she's got nearly 3 decades until she can access this money. So we feel, and we discussed together and agreed on, that it would be more suitable to be in a high growth option. So then what we look at are the returns and the fees. So the last 12 months, and 12 months is probably a bit too short of a time frame to really get an idea of that investment option. But just to give you a sense, that conservative option has done 6.04%. On the right-hand side, the proposed fund, which is the high growth option within Aware Super, 10.66%. What you can also see is the fee differential. So what we really focus on as well is driving clients' fees down in their super, which is a guaranteed return on their money. Fees aren't everything. We also need to look at the quality of the investments, the performance, the brand of the brand of the super fund. That is important to us as well. 0.7% is what she's currently paying. So as her balance rises, the dollar fee increases because the percentage is always on a higher balance. So what we're looking to do here is we found a cheaper option within Aware Super that is high growth. And as you can see, halves her fees, which doesn't save her much now, but over the long term, if we forecast this out, can be a really big difference of $161,000 from where she's heading currently to where she's going to get to. Now, this is based on her not salary sacrificing 12% super guarantee contributions. I think Glenn made a mistake with the case study, but it did look like she had nearly 18% contributions, but we'll assume 12%, and that was a mistake. But this is more just to show the impact of making some small changes earlier in Olivia's life over a 32-year period. For Sam, he's in the Australian Retirement Trust high growth option, $92,000. That's a really good asset mix for his stage of life, in our opinion, 89% towards growth assets. If we then look at what Sam's paying, his fees are 0.92%. And this is where some super funds, it can be really hard to understand what you're paying and if you are in the right option. Some super funds, like Australian Retirement Trust, have a high growth option that Sam's in, but they also have an index high growth option that is much cheaper, which is the proposed option on the right, 0.3%. The performance over the last 12 months has been slightly better. We're not really worried too much about that. It's more about the cost and the fees, because over time, that would have a significant difference to his balance. If we assume both high growth options get the same return, the fees alone will have an impact of $202,000 over the next 29 years for Sam's super. And that's simply because that percentage fee does not cap out. So when Sam's got $1 million, if the percentage fee is 0.9%, it's paying $9,000 a year versus, say, 0.3%, $3,000 a year, and that compounding effect over time. Now, we also kind of do a bit of a pulse check on where their balance should be for on track for a comfortable retirement. They are a bit behind, but the priorities and the focus at the moment is not superannuation. That will come once their kids are a few years older, get sorted in the house, and then we would consider a contribution plan to either catch up or get to a point where they're working towards their desired retirement. If we were to contribute extra to super, given Olivia's income, she's in just in the 30% tax bracket at the moment. If she contributes to super, instead of paying tax at 30%, she'll pay tax at 15%. Sam, if he contributes to super, salary sacrifice, instead of paying tax in his tax bracket of 37%, he'll pay tax at 15%. So as a household, it's actually better and a bigger tax saving for Sam to contribute to super. But if Olivia wants her super to grow and they're on the same page with that, Sam could do the contributions to super and then do a super split once a year, which is where you can move up to 85% of last year's contributions to your de facto or spouse to equalise the balances in time. We could also look at spouse contributions, could also look at government co-contributions for Olivia as well, given her income. All of that we would look at. The final thing that they mentioned was around the self-managed super fund to buy a property. Given it's a lot harder to lend money within a self-managed super fund, typically you need 30% deposit. That their balances just aren't enough to make that a viable solution for the cost of setup that an accountant would charge, but also the ongoing cost, in our opinion. So we would discount the self-managed super fund for now, potentially reconsider that in the years ahead when they're getting closer to $300,000 to $400,000 would be a starting point to at least consider it from there. Now, that's then the strategy phase. So hopefully you found that of value. Appreciate you sticking with me and letting me waffle a bit. From here, what we do is then once the Sam and Olivia are on board, we'll formalise this financial plan. 50-page document, typically tailored to Sam and Olivia. What are we recommending? Why? What are the risks and all the alternatives? All the forecasts are in there. We present it to them. They sign off on the work, and then we'll go away and help them implement it. So whether that's making tweaks to their super, getting insurance in place, helping them get wills done, new investment accounts, assisting with the structure of their new banking system, working with a mortgage broker, we will help them through that journey to make it as easy as possible so that it all gets done. From there, the clients have the option, Sam and Olivia have the option of being an ongoing client of ours where we catch up regularly, keep providing regular advice and stay abreast of their situation, or they may have opted for one-off advice. And from there, they move into more of a reactive stage where we'll touch base once a year via email or a call. Other than that, we just wait to hear back from them for trigger points in their life where they might need more advice in the future. We go back to the top and charge another one-off fee for the new work that they're wanting us to conduct. In terms of the value that they get out of our advice, hopefully it's been quite clear throughout. The super one's the easy, tangible benefits through those fee savings and kind of better investment returns, particularly for Olivia. It's with their cash flow, it's then also kind of being better, having better money habits, getting ahead earlier, refinancing, potentially exploring that. Maybe some better structures with their investing, lower costs for the investments. So there's a lot of kind of tangible benefits. The other side of it is greater level of education, peace of mind, more financially in control, and having a plan that now they can stay motivated too. So thanks so much for your time. If you would like to have a consult with us, please reach out to us at Everest Wealth. Have a great Christmas and New Year, and thanks for your time.